This is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks.
Yes, I do have a concern about commercial real estate.
Canada's largest pension fund sold its stake in an office building for $1. 19 Elms in London was sold for 13 cents with a debt of about $800 million attached to the building. West Loop Landmark in Chicago sold at a 90% discount. These are all signs of trouble in the commercial real estate sector. Commercial real estate is buildings or properties used to generate income or for business purposes like offices, hotels, shopping centers, and warehouses. There's a massive amount of commercial real estate debt. Approximately $5.7 trillion in commercial mortgage loans will mature between 2023 and 2027, with U.S. banks holding about half of this amount on their balance sheets, leading to difficult decisions for lenders and borrowers. Rising interest rates over the past 2 years globally is a major problem in the commercial real estate market. In the U.S., the Federal Reserve has raised interest rates 11 times since March of 2022. For commercial real estate investors, going from a 3% to an 8% interest rate can destroy the value of the assets. Compared to home mortgages, commercial loans mature after a much shorter time, usually 10 years or less, and typically end with a balloon payment for the remaining value of the property. Few owners can afford to pay off the full value, so refinancing is the norm. But when lower valuations meet significantly higher interest rates, it's just not going to work, and there'll be losses all around. About $929 billion of commercial real estate debt will need to be repaid or refinanced in 2024 in the US. $270 billion of this debt was due in past years but has been pushed forward into 2024. This is common in the banking industry and is called extend and pretend. Banks extend the time that struggling property owners have to find tenants to pay rent for office buildings and pretend that the extensions will allow landlords to get their finances in order. These extensions allow more time to work out refinancing of some sort so that banks don't have to write off the value on their books and take back the properties. This is all based on the idea that things will eventually work out and all parties would walk away with little to no losses. However, with interest rates still remaining high more than halfway into the year, banks have had a rude awakening that many property owners, especially owners of office buildings, will default on mortgages, which means big losses are inevitable. As a result, some Wall Street banks have begun offloading their portfolios of commercial real estate loans in order to cut their losses. The office space sector is the biggest problem. There's been an office real estate crash caused by the rise of remote work due to the pandemic and high interest rates, which have both decreased the demand for office spaces. In the second quarter of this year, the office sector set a record vacancy rate at 20.1%, going over 20% vacancy for the first time in history, according to a Moody's analysis. It's gotten so bad that some developers are even working to turn their office buildings into apartments, which isn't such a bad idea given the ongoing housing crisis. Despite some high-profile return-to-office pushes, recently the fastest-growing work arrangement is the structured hybrid work model, where companies have specific expectations for in-office work, such as a minimum number of days or specific in-office days of the week. Majority of the banks with the greatest exposure are small and medium-sized financial institutions. They tend to hold more commercial property loans and also often have less capital than the larger money central banks. With 56.1% of all commercial property loans, small U.S. banks face the highest risk compared to other bigger banks. Earlier this year, New York Community Bank lost more than 50% of its market value after reporting potential losses totaling hundreds of millions of dollars in its commercial real estate loan book. Foreign banks are also caught up in this mess. Aozora Bank, a mid-sized Japanese bank, Canada's Imperial Bank of Commerce, and Germany's Dutch Bank all have billions of dollars in assets tied to U.S. office loans, mostly in large cities like Los Angeles. As of July 2023, European banks reportedly had 1.4 trillion euros tied up in the commercial real estate sector. A potential credit squeeze in this market could spread through the economy, resulting in reduced bank lending, reduced business investment, possible bank failures, and an overall negative impact on economic growth. This is known as contagion. The decline of the commercial real estate sector is bad for urban cities and central business districts, as it could result in what's known as the urban doom loop. A doom loop is a situation in which one negative economic condition creates a second negative condition, which in turn creates a third, resulting in a downward spiral. The shift to remote and hybrid work decreases office space demand. Lower demand causes property prices to fall. Lower property values result in lower property taxes. Local governments will find themselves with huge budget deficits and be forced to cut back on key public services, such as policing, transportation, and education. As a result, crime and homelessness will rise, and the quality of public services and amenities will decline. Residents and businesses will leave cities in droves, which will further lower the city's tax base. Cities that rely largely on property taxes are the most vulnerable to the urban doom loop cycle, like Atlanta, Boston, and San Francisco. The future of commercial real estate, especially the office sector, looks gloomy. Will interest rates come down just in time for major losses to be avoided, or will there be widespread bank failures? Only time will tell.